Good morning. Welcome to Stock Market Today for Thursday, May 21st, 2020. I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter at @DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where we get a lot of the content for this show, as well as offer up some stock ideas for you to consider. That hits your inbox every trading day before the market opens. So U.S. equities were higher in Wednesday's trading, with the S&P 500 ending at its highest level since March 6th. All sectors were in the green on the day, led by energy, but healthcare did lag the broader tape. Go back to Tuesday's show about that consolidation and the relative strength of healthcare. Treasuries were stronger across the curve. The dollar was down against the euro and the yen. Gold finished up 40 basis points. WTI crude settled up 4.8% for its fifth consecutive gain. However, as we get to the desk this morning, futures are under a little bit of pressure in early trading on the heels of a weak session in Asia overnight. Europe is largely on the defensive as well. Treasuries are mixed, with strength at the back end of the curve. The dollar is stronger against both the yen and the euro. Gold is down 1%. WTI crude is adding up 2.3%. So we've gone through the initial resistance, 29.50. Closed above it finally. And now we will have the much anticipated showdown, the S&P 500 against the 200-day moving average. I think this is the clear line in the sand for a lot of people from here. Remember, go back to yesterday, the spec net positioning, staying short to the extent that some of that is systematic and rules-based. Staying short could largely be a function of being under the 200-day moving average, right? If your system says I'm long stocks when the S&P is above the 200-day and I'm short stocks when they're below, well, you've stayed short. And your trigger to cover would be trading above the 200-day moving average. So I think that's going to be important. On the downside, we've moved up our near-term support zone from 2750 to 2800 to 2800 to 2850, as that is the lower bound of this gap opening this week. So tweaking up that support zone. Should it give way, we have to start thinking about 2490 to 2670 on the downside. Resistance, we're in that 2950 to 3000 zone. You'll notice that the 200-day moving average is right around 3000. So round number resistance, rules-based potential buying or staying short is going to be a show. Or maybe it won't be. Maybe we'll slice right through it like it's not even there. Who knows? Moving toward overbought levels on that 13-period CCI, and Chaikin money flow does remain bearish. So that's kind of the structure that I see. I do think that this level is key. I've said that this level is key, right? Back here, we started writing about the fact that we thought the initial low was in. Over here, we started writing about the fact that we thought there was upside to 2800 to 2900. And then we started fine-tuning our levels from there. The next key levels, well, I've been laying them out for you for a few weeks. So I think it's interesting here, and we shall see what happens. Turning now to our market in a minute, what are we writing about today? Well, we broke from the recent trading range and will now contend with that 300 level, so the 200-day. Some divergences in breadth metrics on that range break, which is kind of interesting to me. We'll touch on that later in the show, and there's much more detail in my note. We're screening for bearish candidates should support give way. Financials, industrials, two of the areas of the market that we'd like to see get in gear, failed to join the market's range break, and futures do point to a lower open here today. Now, the power bars did see some improvement across the board yesterday. To the Dow added 1.5%, 4 bulls, 9 bears. S&P up 1 3/4, 71 to 149. NASDAQ outperformed 33 to 13. This one just continues to expand. Small caps outperformed on the day, 420 to 312 bulls to bears there. Interestingly, as the market went higher and broke that range, bonds went higher as well, sending yields lower. Energy best performer up nearly 4%, 0 bulls, 23 bears there. I said we were going to screen for some bearish candidates. in case those support levels start to give way. So I looked at the S&P 500. I've gotten a lot of positive feedback on including these screens both on this show and in my note on Thursdays. So I'm going to continue to do so. So what I wanted to screen for was, the S&P 500 stocks with a very bearish rating that are below that long-term trend line that we highlighted in our notes, that also have weak money flow and weak relative strength. So basically, the process that we look for bullish ideas in reverse. All right, so should the market begin to roll over from here, should that 200-day hold, and we start to break below those near-term support levels, right, 2,800 to 2,850, what are some names that if you own them, you have to question why you own them, or names that maybe potentially set up as bearish ideas? And I think that this is an interesting way to kind of sort those out. So, as you go back and do your work, as you're building lists, which I highly advocate, both bullish and bearish watch lists, I think these are some names that are bearish watch list candidates that should the market begin to roll over and take out support, you want to potentially be looking for bearish opportunities, right? Some of these big industrial names like Deere and Dover, right? The financials, Goldman Sachs, Wells Fargo, right? The REITs continue to be a mess, right? You can see a nice mix of the areas of the market that you would expect to do poorly if the next leg down was beginning. So take a look at this screen. It's also in my note if you're, taking the 14-day trial, or if you're a client of Chaikin Analytics, you can take a look at that note. Turning now to our sector tracker, movement of the major sectors over the last 5 days. Energy at the top of the list. So that counter trend move in energy continues to play out. Remember a few weeks ago, we started talking about the interesting divergence between energy stocks and crude oil. Now crude oil is rallying, energy is holding firm. So, 2.5 weeks ago, we started seeing energy no longer look like the layup bearish trade. And while I can't get super excited about being long, I can certainly say that no longer being bearish was the right call. Industrials, we're going to take a look at industrials and financials a little bit later in the show. Discretionary, doing well. Remember, Amazon's a big weight there, but go back and remember yesterday's show where we looked at the retail names on an equally weighted basis. We started to see some encouraging signs in retail. Materials are probably, of all the reflation categories, materials are probably the one that look most interesting to me. Tech still doing well. Would love to see it get back towards the top of the list. What we want to note is your defensive sectors are at the bottom, and all groups are higher. So that's an encouraging sign, but we have to think about what would happen if we fail at the 200-day moving average. Turning now to our industry in focus, semiconductor services, which has been a good one over the past 6 months, leading the S&P 500 by over 10%. Power bar ratio, which hints at future potential, keyword being hint and potential. 9 bulls to 2 bears. That's very strong. It's currently ranked number 4 of 21 subsectors, and it's moved up 8 slots over the past week. So some of the names there that are interesting: First Solar, FSLR, Intel, and Smart Global. Intel very bullish, First Solar very bullish, Smart Global, SGH, is a bullish rating here at Chaikin Analytics. And rather than look at the group, I figured I gave you a screen, but let's give you a stock as well, because I think Intel looks compelling as a bullish idea on this breakout. Intel, very bullish stock. Strong trend above that rising long-term trend line in a strong industry group, as we just said. Semiconductors have a bullish power bar ratio. So you had this rally, consolidation, topside breakout through the consolidation, bullish stock outperforming the market, bullish money flow, not overbought, not oversold. So if you're a range breakout person, your signal is in play. For me, the way I've been doing things lately, just given all the volatility in the market, is I've been opening half positions, right? I have my ideal position sizing, and I'm trading at half those to start. Managing risk the same way that I always do. But in a name like Intel, right, if I would normally like a really core position to say be 10% of my portfolio, I I'd open with 5% and then look for opportunities to add. That's how I've been doing it in the names that I've been buying. Just kind of looking at the stocks that are meet my criteria and taking half my size and then adding at strategic points. Turning now to our trends, right? Our gainers and losers over the last day. MGM at the top of that list. Penn National Gaming had some commentary about initial results of one of their casinos in Louisiana reopening, and that lent a bid to some of the other casino stocks as there were signs of pent-up demand, right? I mean, gamblers going to gamble. So as soon as the casinos are open, there was pent-up demand there. National Oil Well Varco, a bearish stock here, suspending their dividend. Stock rallies 8%. Twitter, no real news that I could tell. Up 7.86%, bullish rating here at Chaikin Analytics. Holly Frontier, nothing company specific to drive that one up 7 3/4 on the day. ADI earnings sent the stock higher 7.75% on the day. Loser side of the board, Becton Dickinson does a capital raise. Market kind of wondering about it, I guess. Raising capital sent the stock lower by 7.7%. Gap, JW Nordstrom, and Kohl's are all related. Kohl's earnings and the kind of negative commentary around it weighed on that stock, weighed on the group. JW Nordstrom, bearish rating down 4%. Gap down 3.5%. Royal Caribbean, nothing company specific to drive trading there. Let's dig into our breadth metrics now. So percentage of stocks above their 200-day moving average has gotten above 30. That's encouraging. Right? Slow grind. We've been talking about how it's been a slow grind. Getting above 30 is encouraging, right? Especially with the market now potentially set to do battle with the 200-day moving average. In an ideal world, we love this metric over 60, right? That's a healthy majority of stocks being in long-term uptrends. But when you're coming from the depths of this despair that we've seen here, I think it makes a ton of sense for a slow grind higher. Percentage of stocks above their 50-day moving average, above 80, right? So intermediate term, solid. What bothers me in my breath work today are three things, one of which I can show you here, one of which is in my note, are divergences. So if we look at the advanced decline line, which has done a great job of tracking the S&P 500, as the S&P 500 has broken out of the range, we have a series of lower highs for the advanced decline line, right? So again, just maybe a lack of participation starting to show up. Now, if you read my note, I include the percentage of stocks above their 20-day moving average. That has negatively diverged as well. In addition, a custom indicator that I built that to track the percentage of stocks in the index that have a bullish or very bullish rating at Chaikin Analytics is flat. Right? It's reached its recent high as the market has broken out of the range. That is a divergence in some respects. So those have caught my attention. They await confirmation, but something I'm paying close attention to. On top of that, we want to see more of these important cyclical groups join the party, right? Materials have done well. We've highlighted those this week. Energy, we've highlighted the fact that it's no longer a layup bearish trade. But financials, right? Market's breaking out. Market's breaking out of this zone, right? That, higher. Market's about to test this 200-day moving average. Financials didn't break out. Nowhere near their 200-day moving average. Bearish money flow, not overbought, not oversold, but you get my point, right? We want to see more of these groups getting in gear with the market to have confidence that the market can break higher and continue this uptrend. Participation is probably the biggest sticking point to a sustained equity rally at this point. And the same goes for the industrials. You can see it on the chart, and I will leave it there. Have a great Thursday, everyone.